have Mihir Vora also joining us in the studio, CIO, of course, Trust Mutual Fund. Hi, Mihir. Good to be speaking with you. First up, you managed to catch the match?
Of course. Who would not?
I don't know, like around that 13th, 14th over, people like me had shut down the TV thinking it's not going to happen. It's a repeat of November. And once you heard about that 15th over, which I missed, on 16th over it was on and then it was just one way from
so
there.
So you know what the trick is for every match.
Maybe I should just switch off
and we'll win it.
I know if it means India winning, I will absolutely do that.
You're like the investors who always think markets are expensive. You got out.
Exactly. And then there is a massive rally.
Maybe I should stick to ways like SIP that just keep them on at the backdrop. Don't actively do anything because the moment you get active, the market gets a bit dizzy.
Absolutely. No, it was an amazing weekend. Couldn't have asked for better.
Absolutely.
No, but you made a very important point
too.
out there.
Yeah, go ahead.
I mean, he made a very interesting point. You know, the other day I was at a gathering and everybody was cheering, and of course, Manish Chokhani was also there, and everybody was cheering how, in his introduction itself, you know, the gentleman said that he's renowned to have called the two tops in the market in the past. He exited right at the time. But when he was finishing his speech, he said, you know, the point is that I got out. Yes, I called the top right, but I exited a significant position from the market at that time. This time round, even if calling tops and bottoms is something we only learn with experience, but I don't want to meaningfully pull out of the market because subsequently there was a massive rally and then you. So that's a question I would like to start a chat with today, Mihir. At 24,000 odd, a lot of investors who have made very handsome gains in their portfolios, trading books, as well as running their own money, are feeling they've disproportionately made money, and it is also triggering a feeling to book out. What should they do?
Certainly. So of course, it's tougher to pick stocks now than it was say a year or two ago. Sure. Definitely. So I would say the universe is getting narrower, and most of the themes that we are talking about are no longer undiscovered. On the other side, the liquidity flow from the domestics continues relentlessly. And we are amongst the few markets where the broader markets are doing so well. Of course, the large cap indices are doing well, but even the broader markets are providing a good support to the market. So my guess is that the markets are looking towards the fact that for the next 5 years, we will continue to see policies which will foster domestic manufacturing growth, which will continue to see infrastructure being created. And the fact that we need to, now compete with China in a meaningful way is getting ingrained into the business system. So that bullishness and the hope that private sector investments are coming in and will continue to come up, and hopefully in the budget we'll see some more announcements for corporates to start investing. That's what's keeping the sentiment alive. Plus, the US economy has been much better than expected. It's been stronger for longer, and of course, then it also translates to higher interest rates for longer, probably. But the fact is that the US economy is doing quite well.
Right. Yeah, go ahead.
Yeah. No, what I wanted to ask really was, 6 months done for the year already. What lies ahead? Do you think that now you'll have to sort of hunker down your expectations on a return basis? Is the best for the year already behind us? Has it already played out? And I ask because, there are a lot of political developments, a lot of global elections, the big one being US. And, for us as well, while it's always the chatter, whether there's going to be any tampering on capital gains tax or not, but the chatter is there. And there's always nervousness around the budget.
Certainly. No harm in being a bit cautious and selective. So the one thing that we need to do is not go down the quality curve. Just because a stock looks cheaper in the SME space or the small cap space doesn't mean that
it's good.
So in such a not exactly frothy market, but in such a bullish market, I would say one needs to make sure that we don't compromise on the basics, the fundamentals. You might end up losing a little bit of money, but it won't be a permanent loss of capital as long as you are in quality stocks and quality companies.
Okay, don't give up on quality, don't get that FOMO and invest in any stock at any valuation. But the other thing I wanted to discuss with you, Mihir, is financials, right? That's one space which is underperformed. And I was going through your top holdings. It continues to be ICICI Bank, HDFC Bank. You expect them to finally come out of a slumber and be big outperformers from here on?
Certainly. So on a relative basis, financials are, I think, the most attractive. Though they have disappointed surprisingly, in spite of having the best ever asset quality, decent growth, but the concerns about liquidity being tighter for longer are probably weighing on the sector. Plus the RBI's not directive I would say, but indications that they might expect some tempering on the personal loans, the unsecured loan part. That's probably weighing a bit on the sector. But as far as the current fundamentals are concerned, I don't think we've ever seen valuations and fundamentals so attractive.
Perhaps they have been on the receiving end of the massive FIs selling for the last 2-3 years because they were kind of. Do you expect now FIs to come back because they may not have any alternative to the kind of superior growth which India offers and size and liquidity as well? You've been an FI yourself in one of your avatars. You understand their psychology and investing style well.
See, if you look at the long term, we've been discussing so many times, the India story in the last 3 years has never been relatively stronger in the global scheme of things. I think India is the best emerging market story as far as the global perspective is concerned. I mean, we all used to talk about Brazil, Russia, India, China. I think it's only India left now. Probably a little bit of Indonesia to some extent, but India does stand out in a big way. So long term, I don't think there is any doubt that we will continue to get FII flows, portfolio, as well as FDI flows. In the short term, I think what could probably weigh on the market is this theme that we talked about, that the US is doing so well that interest rates in the US and the Western world might remain higher for longer. And you can see some stress building up in the global system because of that. The biggest data point in the short term that I would look at is the Japanese yen. Because the Japanese yen has depreciated so sharply in the last few days that it is causing concern. Two issues. First is Japanese investors are amongst the largest investors globally. So you might see Japanese investments getting pulled out from other markets because of higher interest rates.
Go back to home market.
Go back to the home market. That's one. And the second is, if as a reaction to the strong yen, the Japanese government starts tightening, then there will be a further leg of competitive tightening in currency volatility. So that's one immediate risk factor that I see.
Ashu, I see a good representation in one of the sectors is telecom. Now telecom after 5 years is seeing the first hike, and the general expectation is that there may be another one 6 to 8 months down the line. And one of the sectors where fundamentals are improving pretty sharply. But they have rallied as well in the last 6 months. How do you kind of balance it out? Do you see more scope for expansion if tariff hikes flow down to numbers and one more comes along?
See, telecom I see as a steady growth sector now. I no longer see it as a very low growth sector or a very high growth sector. If you look at the macro, long-term macro, when the telecom sector was growing at fast rates because the penetration was low, the spending on telecom as a percentage of GDP went up to almost as high as 2% of GDP. This was in the mid 2000s, etc., when the sector was growing exponentially. Then you had this big tariff cuts as the big player came in 2016-17, and then the percentage of GDP came down to as low as 0.5%. So from 2% we went to as low as 0.5% of GDP, and now we are creeping back gradually. But it won't be a super growth sector. It will be a good, decent. I would treat it more as a consumer sector, FMCG kind of sector.
Wow.
Where is super growth happening in your view?
Super growth, we all have been discussing all those themes, so many times.
But it's getting priced in as well. No?
Absolutely. So one needs to be more picky, choosy. And the other thing that is emerging is probably, a little bit of more populism than last year. We are seeing that already in a few states, whether by the opposition ruled states or in the in the incumbent government's ruled states. So that's another thing that we need to
So does the FMCG and the rural plays, be it auto across the band, also become a tactical play?
More tactical, yes, I would say. Again, FMCG won't be a super high growth sector over a long period of time, but yes, tactically it does tend to act as a defensive from time to time.
But what's conspicuously missing in your list, at least from the Flexi Cap Fund, is no pharma names, or at least not a big representation. Not yet time to go overboard on pharma?
No, we have. It may not figure in the top holdings, but we are kind of neutral on the sector. We have 3-4 names in the segment, so we're neutral. But I think the worst is over for the sector, and we'd be looking to pick more stocks in this segment, I would say.
But what, healthcare, diagnostics, the manufacturers, exporters, domestic facing?
More of the generic exporters, because that's where the maximum stress was for the last 4-5 years, and that's where we hope the turnaround will happen.
So Mihir, in your Flexi Cap fund, what is the average valuation of that fund versus 1 year forward earnings growth picture?
So our price to earning ratio for the fund as a whole would be around probably around 30.
Okay.
Which is a little higher than the Nifty 500, I would say. But then our earnings growth is also higher for the portfolio. So while the Nifty peg P to growth would be around say 2 or 1.5 to 2, our peg would be between 1.5. So
And
we have
earnings
higher
growth?
growth as well as higher valuations.
And
in the
earnings growth,
portfolio.
30 something?
Absolutely, yeah.
So that you are, I mean, if you form a good portfolio of companies with 25-30% kind of earning visibility 1 or 2 years far out, it's okay to play slight high on the premium, on the valuation
Absolutely.
side.
So I always keep telling, you can't look at PE ratios on a
Alone,
standalone
yes,
basis.
yeah.
You have to adjust it for growth, and you also need to adjust it for ROE and the cash flow of the underlying.
I have a question for you. In a very high growth and super growth category, every company in that category, electronics manufacturing is what I want to talk about. But there are half a dozen big companies where, liquid, well traded kind of companies. Then there are a bunch of micro caps. I won't go there. But the 5-6 top names, 50% kind of CAGR and visibility for next 2-3 years, right? Is it prudent to even look for fresh purchases in some of those electronic manufacturing names? Some of them have semiconductor play now emerging. Parts. Of course, auto is the most normal one, but complex electronics also. Is it okay to purchase there fresh?
So we have a couple of names, of course, in the portfolio, but we need to be picky and choosy. So for example, if the company is looking at a large capex, then you need to adjust for the fact, and you need to understand that when a capex happens, the utilization may not happen immediately, right? So there might be some periods where you might see that the depreciation, etc., hits, and then the turnover picks up. So you need to be ready for quarter-on-quarter volatility in companies where there is a lot of capital expenditure happening. There are certain companies which are doing more modular stuff. There the visibility is more, more consistent, less volatile, so to say. So you need to adjust for those kind of factors. But having said that, the macro tailwinds are obviously in place.
Before we let you go, a quick word on cement. Because we have a very large cement player lined up right now. Mr. Hari Mohan Bangur is also waiting by Sri Cement MD. But before that, before we go to them, what is your take on cement? Are you playing cement mid cap, top tier? Because it's only been an efficiency story so far. Pricing, I mean, it's so much under kind of regulation of sorts. But how do you place cement in your portfolio?
So cement, we are, I would say, neutral, and I would not play for margin improvement in the sector. So we prefer stocks which are going for capacity expansion. So over the longer term, I'd rather favor volume expansion and capacity expansion rather than margin improvement. If it happens, then it's a bonus, but I'm not betting on it.
All right. Sri Simran, of course, one of the most efficient players in the space. Thank you very much for dropping by me.
Always a pleasure. Thank you.
Okay, time.